Hey everybody, Boris Lester, BK Forex. Welcome to our Forex Weekly Technicals for 9/15/9/19/2014. Where are the trades? Well, very interesting week this week. Obviously, a lot of changes in the majors. The euro, I think, is kind of interesting because we've been talking about this for a week, and I think the case is getting even stronger for a potential bounce. When you're looking at the euro technically, you basically see close to 1, 2, 3, 4, 5, 6, 7, 8 days of timeline where we have not been able to break the lows at 28.50. And the fact that we haven't been able to break down below 28.50 for such a long time suggests that we're now starting to build a rounded base in the pair. And as a result, you're basically seeing, I think, a potential short covering rally here, possibly to all the way up to 31, but certainly you're going to make a run towards the 30s, maybe 30.50 as the week progresses next. So I think euro is basically set up for a short covering rally. Now, the alternative scenario here, and it's definitely worth watching, because let's say next week we obviously have the FOMC, and if the FOMC comes in super hawkish, let's say they drop any reference to an extended period of time, and perhaps even accelerate their language and hint at the idea that interest rates in the U.S. could rise as early as Q1 instead of Q2 of 2015. If we get any type of that kind of movement, we certainly can break this base here. That's why this base technically is so important. This 28.50 level is very, very key. If we start breaking that, if we drop below 28.50, it opens up the prospect now of testing the 27.50s, the 2700s, and even all the way out to 2500 levels for the euro dollar as the one-way train to the downside continues. But if we have any sort of hesitation on the part of the Fed, or any kind of recalcitrance on the idea that that interest rates are going to go up, mainly because the consumer and everything else in the U.S. is still not quite as sound as the Fed thinks they are, then the prospect for a short covering rally is very much there. So this idea of buying this dip is not without risk, but the risk is very clearly defined here, I think, by the 29.50 level. That the break here to the downsides opens up a fresh new area of sell-offs. And it is clearly very, very dangerous to keep buying dips in a clearly defined downtrend. But eventually all downtrends end, or uptrends end. And here, I think a potential here for at least a near-term rally, perhaps even before the FOMC through the 30s, remains relatively strong. So that's the story with the euro as far as that goes. Let's take a look at the yen. Now, the yen has been a story, of course, completely the other way around. It's been essentially a one-way train to the upside. What I think is interesting about the yen, though, however, as you're looking at this, is the parabolic nature of this move. When moves become parabolic, where it's almost like a vertical move up, and we've had almost a vertical move up from 104 to 107, and certainly a pretty strong move from the 103s to the 107s, it does create the prospect for at least a pause and a modest correction within a trend. One of the interesting things that you'll notice here when you're looking at the dailies is that the rate of increase, so 105 to 106, then about 106 to 106.75, then 106 to like 107.25, and then 107.25 to basically 107.40. Every single day, the rate of increase has declined. And that suggests that as the higher we push, the less power we have to kind of push prices higher. So 107.50 clearly, I think, a resist level in the yen right now. 108 probably is going to create a very, very strong desire to take some profits. But bottom line is, I do think the yen has a chance to correct here within the 107, 108 area and come back down towards the 106.50 as a potential test, perhaps even down to 106. Again, this really hinges quite a lot on how the FOMC trades out next week. But if the Fed is uber hawkish, we could have the continuation of this parabolic move, and then you could have sort of a blow off top kind of at around 109. But for now, the rate of ascent has slowed down a little bit, and perhaps for the first 2 or 3 days of the week next week, there's a chance here for a little bit of a profit correction in the dollar-yen pair. The pound is a story all of its own, of course, because the story here is going to be completely contingent on the Scottish referendum, which comes out the 18th. It looks very much like the polls are saying that the no vote is going to be winning. And I think the market at this point assumes that the no vote wins. So the only real surprise here is going to be if the yes vote wins. If the yes vote wins, you're going to see massive volatility in cable. You could have effectively, I mean, if on Thursday there is forward, sort of forward information, advanced information that the yes vote is winning, you're going to see the pound begin to just crater. And of course, 160 very vulnerable. We basically found support at 160.50, but if the yes vote wins, 160 is going to go, 59 is going to go, and probably 58 is going to be the first level of pause for cable, as you're going to create just a huge degree of uncertainty in the United Kingdom over the idea of an independent Scotland. But assuming that Scotland votes no, and basically we're back to status quo, this fills us up to the gap and basically takes us, I think, to the prior break, which is the 64 break, essentially on a short covering basis. Once the Scottish issue goes off the books, of course, the focus turns back to economics. And here, by the way, is where the story gets relatively good, because the economic structure in UK has been relatively good. Commentary out of the BOE has been quite hawkish. We will also have, ironically enough, I think it's I'm not sure whether it's Wednesday or Thursday. I think maybe it's Wednesday. One day ahead of time, we're going to have commentary from the BOE. We have the minutes released, but none of that will matter if Scotland votes yes. But if Scotland votes no, and we have hawkish commentary out of the BOE, then certainly the prospect of a further squeeze and a pretty serious squeeze back up to 64, 65 comes in play as cable sort of does a nice strong bounce off of this massive sell-off on geopolitical worries. So it's definitely worth watching. Cable is going to be a big story next week, and definitely a key trade. But as I said, it's really contingent on exactly what happens with Scotland. So the other big story this week, which is, I think, just been astounding, you haven't seen this kind of liquidation in years, much less months, I would say. So Aussie coming down effectively 300 points off its highs. Sheer assault, contrary to essentially pretty good fundamental data. This is what I think is astounding, and I think this is the key to what's going on with Aussie. Aussie is clearly getting tremendous amount of capital reallocation away from people who were buying Aussie for the high yield to people now reallocating back to the dollar as the potential for U.S. yields to begin to go up comes into play. So the interest rate differential between the Aussie and the U.S. Treasury yields begins to compress, and therefore that makes the whole Aussie dollar trade less attractive. In addition to which, iron ore prices continue to plummet, and Chinese growth story remains relatively muted. None of this seems to actually really matter for the Australian economy, which surprisingly is much more buoyant than I think everybody realizes. As I wrote on Friday, 230,000 jobs were created this year for the Australian economy. That's a very, very impressive, significant number. It's equivalent to effectively like 30 million jobs. No, excuse me, say 30 million? 3 million jobs. 3 million jobs being created in the U.S., which is also a very, very impressive number on a yearly basis. So the bottom line is that there is no chance the RBA is going to cut rates anytime soon. As a matter of fact, if you get to a situation where Australia continues to manufacture jobs and the housing market remains in the bubble that it does, the RBA may once again move over towards a more hawkish bias. Given the fact that we've had a big depreciation in the Aussie all the way down by a nickel, this also helps the whole balance of trade issues, because of course it makes the Aussie less expensive and therefore helps the export sector. So there's a lot of things on a fundamental basis, to be kind of positive about the Aussie. Having said this though, this is technically the quintessential example of catching a falling knife. So the critical question here is, do you want to catch a falling knife? I think the reasonable speculation here is to assume that 90 probably is going to is going to bring out some buyers out of the woodwork. So this whole 90, 89 level would be a relatively decent level to accumulate. But if it breaks 88.50, then the story is over. Then this is a very, very severe liquidation move that could flush out even the hardiest of the longs. So what I would be doing here is doing a scale buying. I would just be nibbling at the heels here, taking small positions and trying to build a position with an 88.50 hard stop. Again, this is a classic example of trying to pick a bottom, but having come down so hard against a fundamental background that's actually quite decent, this is not a bad speculation and may give us a chance to for a rebound towards 91, perhaps even as high as 92 over a period of days. Another way of trading this from a technical point of view is to actually not to try to guess the bottom, is to wait for at least a day or two where the lows are not penetrated on a daily basis. In other words, no fresh lows are made. If we have 2 or 3 days of no fresh lows are made, you may have a little more confidence that the Aussie is finally starting to bottom out. The only danger to that kind of a strategy, of course, is if you you don't necessarily get a chance to wait, because if you have sort of a strong snapback bounce, like let's say it drops below 90 and then runs all the way back up towards 91 on a short squeeze basis, you've missed the opportunity for that bounce. So it's always a delicate balance between trying to find the right price and the right time for the trade. But given the situation here, I think nibbling at these levels is not a bad idea. Last but not least, of course, all the yen pairs are doing well. Dollar yen has been strong. Euro yen has done well. Pound yen has done well. All of those pairs remain relatively strongly in play. Let me just see if I can pull up euro yen. Here's pound yen. Pound yen has been a relatively good performer lately. So they're all bumping up against key resist levels here. And as I said, if you think there's a modest correction coming in the yen, all of these yen crosses could be overextended a little bit as well. The final thing that's on the platter this week, something we don't really talk a lot about, is the Swissy. Dollar Swiss has had a big rally on dollar strength here, but more importantly, Euro Swiss, which we actually traded this week in BK, had a pop on this idea that the S&B may introduce negative interest rates in order to offset the pressure of the decline in Euro Swiss from all this weakness in the euro. So Euro Swiss has clearly found the double bottom of this 2050. We were buyers here and then buyers again. But I think what's interesting here is that you really need to have a confirmation from the Swiss National Bank that they indeed are going to defend this with negative interest rates to try to match the weakness of the euro by creating a weakness of the franc. If you don't have any overt accommodative monetary policy out of the S&B, and remember the S&B meets only once every 3 months, this leaves us in the danger, really, really strong danger of the shorts trying to probe this 120.50 and perhaps even the 120 level. So for now, Euro Swiss is clearly a base, but if this 2050 level gets broken, it becomes a much more vulnerable trade to the long side, and I think I'd be watching that very, very carefully. The flip side of that is if the S&P comes in with a very, very aggressive accommodating policy, then you could have a much greater extension here, back up towards possibly the 22s on the further weakening of the franc. So that's how the week shapes up. There's a tremendous amount of very interesting central bank and other geopolitical risk going on. And I leave you with all of this for the next trading week. Best of luck and the best of trading. Boris Schlossberg, over and out.